Wholesale inflation data is behaving. Meanwhile, investors are awaiting key consumer inflation data and banks' earnings that are about to be released this week. And of course, Donald Trump's inauguration is next week. But we do have Microsoft, the world's third biggest company, just starting to cut jobs. And perhaps that's a sign of widespread job cuts. Welcome to the Daily. My name is Jessica Amir, a market strategist here with Mumu. Well, US stocks have staged another rebound, but it was a choppy session. The S&P 500 lifted ever so slightly, while the interest rate sensitive small cap index, the Russell 2000, gained the most, up 1.1%. And that's because bond yields and the US dollar have fallen. It's all for good reason. Odds are increasing that the Fed could cut interest rates again to some extent after we saw that softer than expected wholesale inflation report being released. Also supporting this thinking is that we do have potential job cuts appearing on the horizon after some of the world's biggest companies have started to wave that flag. Meta plans to cut 5% of their staff, but importantly, the biggest elephant in the room is Microsoft. Microsoft has already allegedly started laying off employees in several key divisions such as security devices and gaming. Let's just bring up the Microsoft chart now to illustrate what is going on. Microsoft shares briefly hit a new 3-month low overnight before attempting to move higher, but now do keep an eye on Microsoft shares. It does appear that the technical indicators are suggesting we could maybe see some algo, which basically means some technical buying, start to occur at these levels. Now, what will probably support a move higher in Microsoft shares and a sustainable move higher is if we do see better than expected profits and an outlook announced in a couple of weeks when Microsoft reports results on January 29. Now, do keep in mind that analysts have been downgrading what we might expect from Microsoft earnings. We've seen Microsoft earnings, in fact, be downgraded by about 0.2%. It doesn't seem like much, but let's just put that into perspective. Now the average analyst only sees Microsoft's revenue rising by about 11%, jumping up from 65.6 billion and getting as high as 68.6 billion US dollars in the quarter. Now, that'll be a record figure still for Microsoft if they achieve that, but it will be the slowest earnings growth rate that we've seen in 6 quarters. And perhaps that's why we've seen Microsoft's shares sell off of late. But do keep in mind that we are suggesting there could potentially be a rebound here. Another thing to consider is that we are seeing, for the most part, stepping back, taking a bigger picture and a bigger look at the S&P 500. Right now, it does seem that investors, or indeed a large cohort of investors, are awaiting to see what happens with Wednesday's CPI data. Now, if Wednesday's CPI headline inflation shows that inflation has risen as expected from 2.7 to 2.9%, or it rises less than that, and if we see US big earnings results from the big banks that report this week, of course, JPMorgan, Citigroup, Goldman Sachs, Bank of America, if they report better than expected results, then the S&P 500 could make a sustainable move higher. Let's keep an eye on that, what happens overnight in the US. Indeed, it is worthwhile noting that options traders are bracing for volatility, as in market bumps, perhaps even disappointment. So that means the road up, if we start to see a rebound here, it'll probably be pretty bumpy. Also consider that gold is on the rise again, as we expected. Now, traders are betting that geopolitical tension will rise, of course, with Donald Trump taking to the White House next week. While we also do have investors starting to, I guess, really price in that the Fed could potentially cut interest rates, maybe even a series of times this year. Now, this does support the rise of gold. Some analysts, including UBS, came out overnight saying that gold could imminently rise to $2,900 US an ounce. Do keep in mind that gold is settling a little bit higher now. It's about up by 0.5%. It's just shy of 2,700 US dollars. So do keep an eye on some big gold producers. Also bearing in mind that Barrick, the world's second biggest gold producer, has restricted supply. They've suspended production at one of their mines in Mali. Also consider that this is happening at a time with restricted supply, while gold demand is actually rising. Of course, that's ahead of Chinese New Year, on top of the other factors that we've mentioned, such as geopolitical tension picking up and bets of rate cuts, which does support the appreciation of gold. So we're just going to show you one stock to keep on your radar, and that is, of course, the world's biggest gold producer, Newmont. It's listed down under here in Australia, and it's also listed in the US as well. Now, Newmont shares have risen almost 8.5% since December 31, but we're showing the Aussie listing here for you. Do keep an eye on Newmont. It'll probably break higher and stage a recovery after falling 32% since October. Also keep an eye and watch other gold mining stocks and ETFs. Why not keep an eye on the world's biggest gold mining ETF? And that is GDX. That's on the screen now. Now, GDX has fallen 18% since October, but it will probably be searching for higher levels in the coming weeks, just for some of the key reasons that I've mentioned. That said, if we do see a hotter or stronger than expected inflation report in the US, that means that moves in gold and some of these gold stocks and ETFs could make bumpy moves higher. Last but definitely not least, the Aussie share market is having another positive day of trade, and we're seeing some of the most gains in, of course, gold stocks as well as lithium stocks. And for some of those lithium stocks, head on over to the update that we provided on our platform yesterday. For more information on stocks and ETFs that we've covered today, head to Moomoo's platform. Thanks for your company for the daily. I'm Jessica Amir, market strategist with Moomoo.